Hi everybody, welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Welcome to our mid-year outlook. Joining me today is Brad Everett, our Chief Investment Officer. And as you guys know, I like to hold ourselves accountable. This has been a very interesting year. And I thought it would be a really good idea to bring Brad back on the show and talk about what we think about the next 6 months, etc. Now, we are long-term investors. We do real financial planning. 6 months is not exactly long-term, but at the same point, we are realistic. And we do understand that many of you read the headlines and listen to the news, and sometimes it can be scary, especially going into a midterm election. So thank you so much for joining me, Brad.
Thanks, Patti.
Love talking to you about this stuff. So let's talk about what we thought back then and what we think now. In January, we had no idea that we were going to be in a war about this time, right?
Yeah, I think I believe you sent out an email to clients. Call it March 4th or 5th. I think that was we were right in the thick of it not disappearing immediately. We trying to figure out what might happen next.
Exactly, and it's interesting because oil at that time was running around $60 to $65 a barrel. It went up as high as 110, and it's back down again. Now, this Iran conflict is very interesting. Why don't you share with us what you learned about our president and how the market has been responding?
Yeah, I think so we're almost back to oil's certainly not back to low prices. It's back to actually what it was in the beginning of March, right? When we started to really think about what was the impact here, kind of that $80 a barrel range. I think regarding the market itself, it actually was very jumpy every day, right? With every announcement that a deal was near, or that something escalated, the market was really kind of would shock up or down. But I think somebody counted, and I think Donald Trump has suggested that a deal is near on like 36 or 37 different days. So I think the market has started to take that with a grain of salt. Doesn't react quite so quickly, and I think is mostly just it seeming to be ignoring most of what he's saying about it more than reacting quickly.
It's sort of easy to ignore it because we aren't as impacted by the conflict, right? However, households really are, because the gallon of gas filling up a tank is $80, easily, depending on the car you drive. Right?
Yeah, it was like really two groups of people, right? There's stock owners, there's the heads of large oil production companies. So as a net exporter, I think in the grand sense of the economy, it's probably pretty good for us as a whole. I mean, that is a lot. It's a lot of revenue, right, for oil producers and stockholders and things like that. But
can I just say one thing about that? I thought it was really interesting because a recent, I can't remember where I read it, but households right now hold a record amount of equities, and it's the highest percentage of a person's net worth right now than ever before. People are being impacted by the market. There is such a thing as the wealth effect.
Well, yeah, there's more. I mean, participation in 401ks and I guess pensions are probably less common than a 401k is now.
Exactly.
So yeah, kind of a regular investment.
And the domino effect is to ask the question: is the market too big to fail? You think about retirees. If the market drops 40%, people are really going to be negatively affected, and that's going to affect politics, right?
Yeah, it's interesting. So there's a lot of money in it, right? And I still think institutions are probably by far the largest players. Mm-hmm. But the benefit of the 401k, kind of this regular every 2-week contribution, is there will always be buying power, mm-hmm. right? You just have an entire country dollar cost averaging in. Right. So yeah, I mean there could certainly be shocks and terrible short-term things, mm-hmm. but I think the idea of everyone just abandoning the stock market and going down 70%, I think seems.
Yeah, there seems to be, when there is a dip, there is a lot of activity. There is the buy on the dip mentality still that is very present in the market. And the U.S. stock market seems to be the cleanest dirty shirt in the closet, right?
Sure.
Although we are benefiting this year from that concept of diversification, that other areas of the market, it's not just the Mag 7. In fact, most recently, the Mag 7 has significantly underperformed, the 493 other companies in the S&P 500.
Yeah, I think the Mag 7 is actually negative for the year.
Yep.
I believe
Mhm.
now I think it was almost exactly 0% for the end of June, and maybe it's down maybe 0.5% or
Yeah.
so. But yeah, I think the S&P 493 is up 15% plus.
And what's interesting about that, Brad, is that we call that right. We were concerned about that in the beginning of this year. And we encouraged all of our clients to just hang tight. We know that diversification hasn't paid off, but we think long term, eventually, the principles of sound money management will come through. And they have. Okay, so I wonder, Brad, if you could define GDP and the two big influences on GDP.
Yeah, but I also forgot to spit my gum out, so I'm sorry if I chew it. I think in the simplest sense, the GDP is really just how productive are the employees and how many of them are there, right? So change in GDP is really just change in productivity plus change in the size of the workforce. And there's, you could really look at each of those components in isolation. We have aging demographics, right? I think the just in terms of retiring employees compared to young people growing into working age, the Fed is predicting something around 0.25% per year. Very low, very low growth in labor force, which is what makes finding some kind of productive solution for everybody on immigration very important, right? That's where our growth in employees would come from, and immigration is down, right, significantly. So that I think that is something that whatever. I'm not a politician, that somebody needs to get an answer to somehow.
Sure.
How can we find new labor supply?
Exactly.
Because I don't think internally we have it. I think we need to import labor from other countries.
Historically, that's what we've done.
Yeah. So that's not contributing to the workforce itself is not contributing to the size of the workforce is not contributing to GDP, but we have benefited from great increases in productivity. So we've been able to still, just since 2000, kind of plug along at that 2.25%, 2.5%, which is fine, right? It is growth.
Yeah.
It's just not, the growth that maybe we got used to for 30 years before. But that doesn't happen. That 3.5-4% growth doesn't happen unless productivity and labor force growth is happening at the same time. It's hard to do with one and not the other.
Sure. And companies are investing a lot of money in the productivity side of the equation, right?
Yeah.
They're investing in artificial intelligence, and that is very expensive.
Sure.
So we were talking about this before we started, and it's very interesting because, yes, I think it's important to invest in productivity. But personally, I think we need bodies also. We need people to deliver the services. We are a service-based economy.
Yeah.
And we need people. So we've got to increase and keep the labor workforce working and, keep bringing them in, right?
Sure.
The other thing that's interesting to me is that when you look at the unemployment for young workers is at record highs. College kids are not getting jobs. So it seems to me that companies are making, in my opinion, short-term decisions, not hiring these college kids and training them to be productive workers because they want the answer in the next 3 months.
Yeah, where they slower to hire, slower to fire.
Exactly.
It's kind of
Yeah. So, okay, so that's interesting. So economic growth, we are growing, maybe not as fast, but again, the bigger we get, the harder it is to keep up that 3.5 to 4% growth rate.
Yeah.
It was easier to do when the economy was smaller, and we are a huge economy, which is really a good thing. It gives us more resilience.
right.
There was a really interesting article that was published by DataTrack, and basically what they said is, typically we would go into a recession every 5 years. In the last 15 years, we've been in a recession exactly for 2 months, and that was during COVID.
Yeah.
That's amazing, really, when you think about such a large economy as the United States only being in a recession for 2 months.
Yeah.
When historically it had been every 5 years.
Yeah.
So again, is it too big to fail? Maybe. Is the market too big to fail? Is it too important? Maybe. That's what Donald Trump seems to be voting with, seems to be, managing his policy on. keeping the market up. Okay, so Brad, we have a new Federal Reserve chairman. He is basically not interested in telegraphing what the Fed is thinking as
Right.
much as his predecessors were.
Yeah.
So now, based on what we see with inflation, it's been very choppy. It went down this month. CPI was surprised everybody by being down, but that was before the more recent increase in the Iranian conflict. So now it's expected to go up because oil's expected to go up. So what do we think about interest rates, inflation, and what the Fed could do?
Yeah, I think the last time we probably did this, we were expecting maybe two interest rate cuts this year. I thought was probably what the market was predicting, and you know, it seemed to make sense, right? That's not a huge move. Two
No.
small cuts is not an abnormal year.
Especially because last year they cut 3 times, right? The last cut was in September of 2025 because at that time people were really worried about the
Yeah.
unemployment rate,
Right, but not
And-
inflation.
not inflation as
Yeah.
much.
Yeah.
But then at that time they didn't realize that we were going to be in a war.
Mm-hmm.
So here we fast forward, inflation has ticked up. We have PTSD from 2022, right? And, you know, after COVID. So they really are focused on inflation. So we're lucky if we stay neutral, right? Stay where we are.
Yeah, I would think that's what you would, you know, sort of the I guess the baseline would be,
Mhm.
right? That's probably the highest probability would just be to stay the same. You know, I think you know they probably paused on any cuts because of inflation, but that seems to be again, you know, you would have oil could really drop a lot if there's any kind of resolution to this. I think one of the big inputs in, you know, previous big inflation numbers was housing, and that's been on a pretty steady decline. So yeah, I think, you know, they don't have to do anything. Sometimes they can just
Best
sit
thing,
tight and leave it
right.
alone, which is tough. I think, you know, you read, imagine if that's your job, you just read for 10 hours a day, and
Right.
you get once every 2 months to act, and you just decide to leave it alone. You know?
And sometimes the best thing to do is nothing.
Yeah,
Sometimes, and that's I think the approach that they're taking.
yeah.
So let's now talk about the markets and our clients' money. What
Sure.
are we doing? Given this information, given where interest rates are today, we are still in this conflict, we've got the midterm elections coming up, and yet the market has been soaring to new highs. What, I don't know about you, Brad, I think it's kind of interesting, the multiples are actually healthier than they were when we first started this year. Right?
Yeah, I think there's a lot of reasons to be optimistic across markets, right? I mean, bonds are at great yields right now.
4.7% is not a bad toll booth collection. Right?
Yeah,
So
especially if you don't expect interest rates to change much. You know, that could be something that is reasonable for quite some time. You know, I think there's a lot of reason to be optimistic about equities. You know, I know there's a lot of talk about it being in an AI bubble and things like that, but I don't see it. I just think there's, you know, there's, so to your point about, I think like at the beginning of this year, there was really a concern about high PE ratios. You know, was the market expensive? Was it concentrated? Was all the return concentrated in 10 companies?
Yeah.
You know, I think maybe the top 10, did they get up to 43% of the S&P? So I mean that does make you, you know, a little nervous that,
Yeah.
you know, that
Is
when
this
that,
a house of straw?
yeah,
Could
when
this come
something
from
unwinds,
now?
it could be pretty
Yeah.
rough. But so, you know, with PEs that high, one of two things could happen, right? You just correct down into a normal PE, right? I think, you know, if you started at 22 and you want to go back to an average multiple, the S&P would have had to come down like 20%, you know, to go from 22 to 18, say, 17. So that could happen, which didn't happen. The other thing, which did happen, is that companies justified the multiple, right? By earnings. The denominator of the equation grew very quickly.
Tremendously.
Yeah,
yes.
so you've had, you know, 10% has come off the PE just from earnings growth,
Exactly.
which has been great. So you've actually, and then that concentration among those companies, like you said, the Mag 7 hasn't performed very well, but the other 493 have. So you've had, you know, that concentration has diminished a little bit too, to where those companies are, and I think it's still probably in the high 30s, but better than it was, 6
So
months
much
ago
better.
anyway.
A lot of people worry because we all have PTSD from the tech bubble. Are we in another bubble? Could this happen again? And when you compare the two time frames, they do look very similar, but it's never linear and it's never really the same, because what's different now is something you just brought up. The earnings are legit.
Yeah.
It's amazing how much money these companies are making. These corporate, senior management of these corporations, they're not stupid. They know how to manage through volatility and to keep their earnings up. And what I think is fascinating is you're not seeing it in unemployment rates. They're not letting people go. They are reinvesting into their futures. The CapEx spending is significant. It is incredible to increase productivity.
Yeah.
So.
Yeah, if you go back, I think, 99 and 2000 was so different, right? I mean, that was the unlocking of so many IPOs, private companies becoming public, stock issuance, things like that.
Yeah.
I think just now, some of them, the big hyperscalers have started to issue debt, like just now.
Right,
So
exactly.
all this spending so far has been done out of free cash flow, money that they actually earned in their normal line of business that
Exactly.
they are spending to just kind of build this out.
Which is a really good point, because the Mag 7 is now, their new term is called the Lag 7. I think
Yeah.
Ed Yardeni started that, and I think it's so true.
That's fine.
Because they are now issuing debt to continue to invest, and other companies are benefiting from those investments.
Yeah.
Because they have to buy the stuff from other companies, the 493.
Yeah,
So we're seeing a really nice broadening out, which I think is really healthy.
yeah,
It's really important, and client portfolios are benefiting from all that.
yeah. I guess the stakes do get higher when they issue debt, right? Like the adding leverage does make it more important that they choose projects that are productive and profitable.
Exactly.
So
And
it
we're
does
not going
change.
to know that
Yeah.
for years and
It
years,
could be a
whether or
long
not it's
time.
really going to transfer, because it takes a lot longer than people realize. I know that we're making significant investment in technology, and I'm going to my operations team saying, TikTok guys, where's this new wonderful modeling that we're talking about?
Yeah.
We have to be so careful because we're dealing with personal information, so it's got to be really tight and managed correctly. But I can't wait, because some of these tools are going to be so amazing when we're all done.
Yeah, I would assume a data center's got to take 10 to 12 years to get done.
Easy.
When you decide to pay for it, how long it takes before you can
Billions of
actually use
dollars. Oh my goodness! Somebody just invested another $50 billion in a factory in a data center in Louisiana. I mean, that's significant money. That is real money that they're investing.
Yeah.
And they've got to issue the debt. They've got to get the money from bonds.
Just to buy the land from somebody. And
Exactly. So the takeaway on the market is the following. Tell me what you think about markets. Next 6 months, next 6 years. Let's say that.
Yeah, I just just reason to be optimistic, right? I think the diversification I think should not be a punishment anymore, right? Bonds should be productive. I don't think they would be a huge drag on returns. Like your toll booth analogy. Say you get 4.5%. You'd be really happy if rates went down 0.5%. Then you're talking about 8 or 9% returns on the ag. So that would be great. I think there's a lot of opportunity overseas. Valuations are great there. I think their economies are different, but even if you kind of account for consumer staples versus consumer staples, right? It converted for industry, they're still significantly cheaper than companies here. They're just great opportunities there. Small cap. I think that would be the one takeaway. I think is to to focus on diversification, and I think that and that it would actually maybe help us.
Yes, make sure that you're very well diversified. It is
Yeah.
really going to pay off, in our opinion.
Yeah.
No guarantees from management, but boy, I'll tell you what, if you want to avoid being killed and you want to just have good, stable growth over time, the principle of diversification typically will win out.
Yeah.
That's what we believe, that's what we've experienced, that's what our clients have experienced. And I love what we were talking about before, Brad, about the bonds, right? And applying that to the financial plan. to really look at each client's situation personally to figure out when are they going to need the money, because it could get choppy here, right? It could get really uncomfortable at times getting those monthly statements. Everybody's been thrilled up until now, but I want to warn you, it may not be so thrilling going forward in the short term.
Yeah. Well, yeah, I guess we never, I'm really puffing up bonds right now, which is something I try to never do. But we're not ever investing in bonds because we think the rate of return is going to be great, right? If you have something coming up that you need to spend money on, it doesn't matter if the yield is 4.7 or 4.3. You probably shouldn't invest in stocks for that thing anyway, right? So you just kind of match the liability as best you can and take the yield that you get, right? It's not we're not picking bonds because we think the rate of return is going to be great. They have a specific purpose for a specific type of investor that wherever in the normal range of yields the bond falls, we need them anyway.
And the beauty of the process of asset allocation is the rebalancing, right? So we choose a target of U.S. versus international, large cap versus small, cash, bonds, stocks, and then as things change, which they always do, both economically, which we've talked about, as well as the markets, and in each client family, there may be an illness, they may need additional capital. That's important for us to know about so that we can match the portfolio to each client's needs.
Right.
That is the beauty of real wealth management.
Yeah, we could say we love small caps, but that's not if you're taking money out, every 30 days, that maybe isn't the best place to do it from.
But what helps is when we have the financial plan, we understand that in advance. So small caps, using your example, Brad, have been on a tear. So when we want to sell high, which we do, that could be used. The excess is used to replenish what was taken out of the portfolio that month. So this process of nipping and tucking on an ongoing basis is really important. It can add to your internal rate of return. When markets get choppy, we're also going to look at tax loss harvesting opportunities, etc. But we don't know for sure what's going to happen in the future. We don't know what's going to happen with each individual family. What we want to do is prepare them. Have our plan, have plan A, plan B, plan C, etc. Because again, we have to remain humble. We understand that we don't know what is going to happen in the future. That's why we do this midterm outlook, to say, okay, what do we think this year and what has actually happened? I believe that the market will end this year in a healthy spot. I also believe that it's going to get choppy, especially getting around the elections. The finger pointing and the rhetoric really heats up. So September, October might be uncomfortable. Just be prepared and know that we are prepared, right?
Yeah, absolutely.
Good deal. So Brad Everett, thank you so much for joining me today. So let's summarize this. 3 takeaways. What do we think?
Yeah, I think, again, diversification first, right? We talked about that. I think Iran is something to watch. I think that is something that eventually could lead to inflation, which does lead to the Fed acting a certain way, and there are actionable things in a portfolio, based on inflation regime that we can do on our end. So it's worth paying attention to, one way or another. And then, I just think, we try to think of it in terms of like a scenario analysis, right?
Yes.
What could happen? This bad thing could happen that sends the market down 20%. This boring thing could happen, which means the market stays flat for a while, and this exciting thing could happen that makes the market go up 20%. What's the kind of portfolio we want that we're comfortable with in all those situations?
A resilient portfolio that can do well to protect and grow the assets, so that our clients who want to use some of that money, we're ready, right?
Yeah, because we really don't have any idea. We can talk about long-term averages, but sometimes the long-term means 10 or 30 years. We need to have a portfolio that will, kind of withstand the next 6 months, and then the 6 months after that, and then the 6 months after that.
Thank you, Brad. Thank you so much for joining me today. And thanks to all of you for joining us for today's mid-year outlook. I hope you have a wonderful day, and really come back in January when we do the outlook for next year, right?
Perfect, yeah.
So join us again, and thanks so much for joining us today. Take care.
The following presentation is sponsored by Key Financial Incorporated. The Patti Brennan Show is intended for general information purposes. Only any non-employee guest speaker who joins Patti Brennan on the show is a guest and is not an affiliate of Key Financial. Their remarks do not necessarily reflect Key Financial's opinions or positions. Key Financial neither prepared nor verified any portion of our non-employee guests' presentation content and has relied upon the accuracy thereof. No portion of the presentation serves as the receipt of or a substitute for personalized investment advice from Key Financial or from any other investment professional of your choosing. Neither the information or opinions contained in this or any podcast, white paper, or on Key Financial Inc.'s website constitutes a solicitation for the purchase or sale of any securities and should not be relied upon as financial, legal, or tax advice. Content may be outdated, and past history is no guarantee of future results or experience. Please seek appropriate counsel from qualified professionals who know and understand your goals, objectives, and potential vulnerabilities. Thanks for listening to The Patti Brennan Show, brought to you by Key Financial Inc., wealth management with wisdom and care. Securities offered through Osaic Wealth, Incorporated, member FINRASIPC. Investment advisory services offered through Key Financial Incorporated. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.